Welcome to Digital Asset News, or Dan for short. My name is Rob, and today we're going to talk about everything that's going on with the Fed rate hike. And on top of that, we're going to take a look at Senator Elizabeth Warren is shouting to stop the rate hikes, which Jerome Powell really doesn't care. He's still going to put up those rates, and it'll probably go 75 basis points, which should be coming up in the next hour or so. And this will lead us to the bigger question and the bigger chats about what's really behind the scenes, which is how things are going to work with unemployment. It's probably going to go increasingly higher. Also take a look at some scary inflation numbers. And the real big question then is recession really the worst thing in the world? And finally, we'll wrap that piece up with a little bit of data and information from Nobel Prize winner Milton Friedman as he explains to us exactly where inflation comes from. Also, we'll talk about how institutions are here and they are driving up demand, and they also have a pretty big foothold in crypto. As far as Bitcoin goes, you know, they have almost 7% of the total circulating supply. It's true. And then also we'll take a look at some positive news as JP Morgan comes out and uses two specific cryptos to do tokenized deposits and transfers, which I think is big news for these two cryptos. And then finally, we'll wrap it up with a little negative news, which we talk about the updates for Celsius, and surprise, it was probably a Ponzi. So let's just break right in and talk about the big first story today. Now, Jerome Powell is going to come out, and in the next 45 minutes or so, he's going to have a press conference. He's probably going to say it's 75 basis points. So I don't see a reason to really talk about that and cover that. Once it comes in, people will say, well, everything's been priced in, so we shouldn't see too much of a drop or a dip. But every single time this happens, the market gets irrational. It's like somebody doesn't know about it, and then all of a sudden there's a little bit of a sell-off. So me personally, I'm not dollar cost averaging today, just waiting for the announcement. Hey, maybe for some reason, Jerome might say we're going to 100 basis points, and that would be a pretty good day if you're just waiting around. But the thing that caught my attention was Senator Elizabeth Warren is calling for Jerome Powell and the Fed to stop raising rates so quickly. And it came down to this piece, which she wrote a formal letter to the Federal Reserve Chair, Jay Powell, and said, look, you guys can't do this. And I just thought it was interesting to kind of go through the minutia of what's happening and what kind of the things that politicians are talking about, and how they're kind of just a little bit of a distraction about what's happening. So first things first, she states, we are writing to express concern and request additional information about the implications of the Federal Reserve's most recent economic projections, its intention to continue raising interest rates at an alarming pace, and your disturbing warning to American families that they should expect pain over the coming months. Listen, I got to tell you, thank God someone comes out and says, look, here's the truth. It's going to suck for a while. It's going to be painful, and it's going to be hard, and that's what's going to happen. I would rather have the reality smack me in the face than someone whisper sweet lies to me, which is not going to help me in my position. I can't change these things. Let's just move forward. So when she talks about, it's a painful thing, well, yeah, it is, but I don't think it's alarming. I mean, just thank you for warning me. The Fed has raised interest rates by 3 percentage points over March, the fastest increase of that size since 1982, which is already estimated to put 800,000 job losses in the pipeline. So just so you know, in the background, all these rate hikes, we're not going to see the effects for 9 months, 12 months, 18 months or so. Moving forward, 18 months is pretty long ways out, but we will lose jobs. The unemployment rates will increase, and it will be painful. And what was fascinating to me is, of course, where did the data that actually Warren pulled this from is actually from this quote from Nancy Vandenhouten, Oxford's lead U.S. economist. And she states, when we look at 2023, we see almost no net hiring in the first quarter in 2023, and job losses of over 800 to 900,000 the second and third quarter combined. I got to tell you, that seems kind of light. I hope that Nancy is correct, but that's where the data comes from. This is where it gets worse. The Fed projects that unemployment will rise sharply from 3.7 to 4.4 in 2023 and 24, implying an additional 1.2 million people losing their jobs. There are fears that the Fed risks tipping the United States into recession and causing widespread joblessness. And before we move on, I have to make a distinction here. And this is from friend of the show, Ben Cowan, over at Into the Cryptoverse. He's got a great website, link in the description. And I'm going to steal all this data. So thanks, Ben, for for allowing me to do that. But we can just see here, we have the unemployment rate. And the whole point of the Fed was to, put a lot of hardship and to drive demand down so we wouldn't see such inflation. They were also hoping, this is true, that the unemployment rate would actually go up. Unfortunately, we can see down here, we went from 3.6 in May to, it went down 3.5 in July. I think we remained flat. Oh, it raised up a little bit in 3.7 in August. And then it went back down again at 3.5%. So the things they're doing, again, we're not going to see the effects 6, 12, 18 months out. But the thing that I need you guys to be aware of is this. Going back to 1950, see these gray areas here? As unemployment rates go up, this is the recession, all these gray areas here. In every recession, unemployment rates must go up. They must go up. It drives demand down because people can't afford things. Inflation rates go down. And you can see here, it's just amazing how it peaks here in 1949, and then it goes right down. Same thing happened in 1953, same thing happened in 1957, so on and so forth. Here's another big one here. 1973, you can see the unemployment rate skyrocket. And what does that mean? Well, we can't afford things, and it just goes back down. Inflation drops, and it goes back up again. It's a natural cycle like everything else. 81, and of course, the last one we see, 2008, 2007, 8, 9, we saw a major distinction. And once there's a max pain, then it goes down. But don't worry, because these recessions are natural. They do go away. But to clear this up, in between these recessionary periods, what do you see? You see economic boom just coming forth. And this is going back to the 1970s. Again, you had about a year and a half or so, and then economic boom. Another year and a half, economic boom. A year, little space, year, economic boom. Same thing over and over and over again. So I understand what Elizabeth Warren is saying is like, look, I'm worried about the American people. I would like them to not lose all their jobs and these things not to happen, but I don't see a soft landing, and I don't see how our ways around this. But I could be wrong. Let me know what you think about it in the comments section. So private forecasters project that your monetary policy path will push the unemployment rate even higher than the 4.4%. Bank of America expects that unemployment will peak at 5.6%. The loss of more than 3 million jobs. So we went from 900,000 to 1.2 million to potentially 3 million jobs. Economists forecast a 63% probability the U.S. will enter a recession. I think we're already in a recession. We can take a look at different factors, and of course, GDP growth has actually changed. It actually has improved over the last time period. But just go to the pump. Just go to the grocery store. Just tell me how the prices are doing, and tell me if your families aren't feeling it. That's how I feel as far as recessionary periods go. And there's different factors you can look at, but that's just how I see things. As you previously stated, the Fed's tools are limited in slowing these and other dynamics. And she states, in your press conference, you said, hey, our tools, which our tools are raising rates, don't really work on supply. Our tools work on demand. We can't affect oil prices or commodities or food prices. There are many things we can't affect, and those are commodities, the war in Ukraine, and so on and so forth. And she's right in this regard, because if they're trying to, stave off inflation by just raising rates, because they're saying that's demand, that doesn't really work too well. There's a real reason for that, and we'll get to the Freeman in a second. And then, of course, through all this stuff that she talks about, and it's good. I know some people hate Elizabeth Warren, some people love Elizabeth Warren, whatever. But here's what she asks for: all the data. Like, hey, what kind of information can you give us as far as these economic projections? Unreached employment forecast described above. Please describe the expected impact of job losses by wage, race, sex, education, attainment, and sector. As the Fed sees evidence that its monetary policies have embedded expectations of recessions among market participants, and blah, blah, blah. So it's a lot of like back and forth and like, tell us what you know, bring us some information. But in reality, there's no resolution. There's nothing else that you can say like, hey, this is maybe a different course. It's just back and forth. But really, in all honesty, there's not much you can say to get out of this. Government printed too much money. And let's be honest, we weren't complaining about it too much when we get all those stimmy checks, right? And we weren't really complaining when the traditional market rose up to astronomical proportions. And we weren't really complaining when we saw that with crypto. Were we not? So here we are. And recession, potentially a mild one is coming, or a heavy one, I'm not for sure. But I just want to remind everybody where inflation comes from. I know we will talk about demand. There's a small part of that. That is true. There are different parts of the socioeconomic factors, as far as global macro issues. But I just want to share this with you. And this is Milton Friedman. He is one of the Nobel Prize winners for economics. And he was right then and he is right now. This is 33 seconds. Just take a listen to this.
Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else. Inflation.
I can't make it more simple than that. And that is just the truth. And we can play three-card Monte all we want to, but that is just the reality of the situation. Print a lot of money, and they should have pulled back. They didn't. Now we're going to feel it. So that's what we have for that piece. And then lastly, we'll just say that there's a person you should follow on Twitter if you have Twitter. John Wick at Zero Hedge. John, or Zero Hedge, full-time option trader, 17 years, really good information, puts out some good alpha. And he states this: once inflation gets above 5%, it has never come back down without a recession. Once inflation goes above 5%, it has never come down without the federal funds rate going above CPI. Federal funds rate is now 3%, a little bit, around 3%. Inflation is 8.2, CPI is 8.5%. So to think that we can get out of this, I don't think that we can right now, but I could be wrong. And I'm waiting for everybody to sound off in the comment section, and I will be reading all of those. But that's what we have for that. Let me know again in the down there in the comments or live chat, and we'll get to that in the Q&A after this. But that leads me to my next point, which is this: diversification. It's important. I know that we want to get rich on crypto, right? We want to be the next Dogecoin millionaire, which congratulations, Dogecoin holders. Good for you guys. So like right now, you may notice that we are not in El Paso. We were actually in one of our rental properties. We were fixing it up here in Condado in Puerto Rico. And I think it's important to take a look at different aspects to get into not just crypto. This is not financial advice, but diversification is sometimes a pretty good sound measure to take a look at. Now, again, properties are good. I'm looking, I've got heavy positions into cash, also some degen plays because I am a gambler a little bit, 5%, nothing big. I do staking, I trust capital, 10% in the Amazon business, land, things like that. And of course, little traditional equities. So real quick, Masterworks, it is fractionalized shares of fine art. I own two, not outright. That's crazy. I don't own a Banksy outright, but a Banksy and a Basquiat. And as far as about a year now, I'm up 40% for the year. And the performance is looking pretty good so far. These are the annualized returns of different sales of high price items, 32, 31, 33. Not bad. But just so you know, it's beaten Russell, NASDAQ, S&P 500, and also crypto for this year. Because the reason is because it's uncorrelated. S&P 500, real estate, and gold. All that good stuff. And why is that? Because rich people love art. This is a shredded Banksy. You know how much this shredded Banksy sold for? 1.8 million. And then it got shredded, and then they bought it for 25.4 million. Just saying. And don't worry, it is registered with the SEC because it is a security. So if you want to take a look at all the information, there's a link in the description, looks just like that, and you can check that out. And that will lead me to my next point. Institutions. I know some people hate institutions, some people love institutions, but they're here and they're buying up a bunch of Bitcoin and crypto assets. And when we get to the JP Morgan, I'll explain a little bit more, but there's a great website. It's called buybitcoinworldwide.com/treasuries. And as far as the different categories, ETFs, countries, El Salvador, public companies and private companies, the percent of the 21 million Actually, it should be circulating supply, but sure, okay. I mean, because we don't have 21 million out there right now. We still got to mine some, right? About 19.5 million or so. It's almost 7%. So institutions are here and they are buying up like crazy. MicroStrategy being one of the bigger ones, 130,000 Bitcoin. Galaxy Digital, 40,000. Voyager Digital still has mine, 12,000. Tesla, 10,000, haven't sold. A little bit. So when we take a look at this and people will say, well, I don't really like institutions being here. It is what it is. And we can only change the things that we have the power to change. And that is not it. So I know when people say, well, I don't know, maybe it's going to zero. Maybe crypto's going to zero. It's not going to zero. First of all, institutions are here. They're buying like crazy. They're buying behind the scenes. They're buying OTC, which is why they don't move with the markets too much. There's a lot of things going on that I think is a reason to potentially think about maybe this might be a good time when nobody wants to get in. And also, as a little reminder, this is from Ki-Young Ju. He's the CEO of Crypto Quant. He put this out a couple months ago, actually. Did you know that 76% of the trading volume in Coinbase came from institutional investors in Q1 2022? 76%, 3 out of 4. And so if you think like a little bit here and there, but it is the truth, and that's what it is. And that would lead me to my next point, JP Morgan. They just used Polygon and AAVE to do a token swap and tokenized deposits. Here's what's going on. This is Ty Lobin. He's the product manager at Onyx Digital Assets at JP Morgan. First of all, what's Onyx at JP Morgan? I had no idea. So this is a permissioned blockchain. You know, we talk about it's a permissionless blockchain. Well, this is pretty much a permissioned blockchain and not decentralized per se. However, it's interesting that they still have to use decentralized tokened assets to move things around. This was formed in 2020, again, by JP Morgan. Onyx has pioneered the world's first bank-led blockchain. Boo. It is what it is, but whatever. Platform for the exchange of value, information, digital assets. They also have Link by JP Morgan, an information exchange network, enables seamless payment-related data. And then Onyx is a blockchain network enabling the exchange of value for various types of digital assets. So here's what happened today. First time it ever happened. First, Ty says we used Polygon for the trade because we wanted to do this on Ethereum. Step back for a second and listen to what he said. We want to do this on Ethereum. We wanted to do this on Ethereum. We wanted to do this on Ethereum. Why did they want to do it on Ethereum? It seems like Ethereum has a big foothold in VCs, in institutions, and of course, for some reason, the banks. I'm not going to speculate why. You can do that in the chats, but it's interesting that he's like, we want to really do this on Ethereum. Maybe it's because it's been around for a while and it's safer. However, Ty knows something that we all know, and that is that Ethereum's super expensive. So we needed cheap gas fees for some expensive operations around ID verification. Future phases of Guardian will explore other blockchains to give the MAS goal for open, interoperable networks. But right now, we're using Polygon. JP Morgan, Polygon. Awesome. Second, we used AAVE so that we could leverage their permissioned pools concept. We deployed a modified version of AAVE Arc so that we could set certain parameters, such as interest rates and FX rates. Awesome. Third, we used tokenized Singapore dollar deposits. This is a deposit token, which is general liability of JP Morgan. It's a native token, given stable, on-chain value. Interesting. On-chain stablecoin, Singapore. There's the contract. And fourth, I think this is the most important, we used at W3C. That's software and tools for permissioned. Verifiable credentials provide compliant access to AAVE. And venture capitalists give much more fine-grained control than just allow listing addresses, because that's what it's all about. Venture capitalism, pulling that money in. That's what they want to do, not what I want to do. Risk limits, asset limits, et cetera, all possible. And we built on-chain verifications of the venture capitalists. Why is that so important? Well, it's because as a heavily regulated bank, we cannot enable money laundering and must undertake KYC using VCs and allow us what's crucial for enabling us to use DeFi pools with certainty on these points. Institutional DeFi, baby. That's what it comes down to. So before we get all up in arms and go, how dare they do that? It's the reality. And that's what's going on. So you just have to take a step back and go, do I like what's going on? Do I want to be a part of this? Do I take a look at the products that they're using? Do I want to be a part of that? Or do I want to go for it? It's up to you. I can't tell you what to do. I'm not a financial advisor. I'm certainly not your dad. So it's up to you to do what you want to do. But for me, I try to change the things that I can change, and that's just one of those things I can't. However, AAVE and Polygon, very interesting. And lastly, just to finish this up, we had some good news, some bad news. This is what it is. Judge orders probe to investigate whether Celsius was a Ponzi. Federal judge overseeing the Celsius case has asked for an investigation to look into whether this was actually a Ponzi itself. And yeah, looks like it was. So the order, this is during the November 1st hearing. There's one just yesterday because the date is November 2nd. Comes in response to allegations from customers that Celsius used assets of new users to pay yields and facilitate withdrawals to existing users. That's a Ponzi. Where you take somebody that's, hey, I got money for you, but I needed to get it from the other people who are already in there. Let me give you your yield. That's a Ponzi. The judge had approved the appointment of an independent examiner because they knew something was going on, a little bit fishy, on September 9th to look into aspects of Celsius's business following calls for greater transparency. Guess what? They found it. They're not saying it's a Ponzi, but they're like, well, there's smoke, there's fire. So let's dig deep into that. Not the first time. Celsius filed Chapter 11. This was interesting. In the November 1st hearing, the federal judge, Martin Glenn, also told Celsius that they would have to include more details in its October 11th motion to pay nearly $3 million. And let me remind you where that money comes from. That's your money and my money that we put into Celsius. To pay nearly $3 million to 62 employees as part of a key employee retention plan. I don't know who needs 62 employees to keep a company going that's not operating. With Law 360 quoting the judge as saying this, I was shocked. When I saw the redactions, I have never seen anyone try to redact everything. You know, you don't want things to be put out there. You don't want to redact, highlight, or black out certain sections, and that's what they did. And Glenn is referring to a section within the motion that outlines the participants of the bonus where every detail relating to the individuals available to the public had been redacted, including their salaries and job descriptions. Look, you can look right now. You can see how much I have on Celsius. You can see how much anybody has on Celsius because it's not public. But they're like, no, we don't want you to put that out because that's our employees. Well, I see where your loyalties lie, and that's fine. So just so you know, there's a couple of people I want you to follow to keep up to date with the Celsius situation. One of those is Aaron Bennett. And he just yesterday talked about, hey, the Celsius UCC racked up $4.2 million in fees in a month. Again, that's your money. That's my money. And here's more. Aaron's doing great work. Also, Tiffany Fong, as she reports out that according to insider source at Celsius, Alex Mashinsky falsely claimed to invest $18 million to Cell's ICO to attract new investors, but never actually invested his own or the VC funds. Was Mashinsky committing fraud? SEC is currently investigating. And last but not least, I cannot bring up Simon Dixon. Oh, where'd he go? Here he is. Simon Dixon is working quite hard. It was actually put out this video with Milton Friedman. Is working quite hard to make us whole, the debtors whole. And definitely give Simon a call. He's been on the show a couple of times, and I agree wholeheartedly with what he's trying to do, and I support Simon for what it is, because the other options that are out there are frankly garbage. So that is it for today. So look, I know there was some bad news and some good news and some bearish news, but look at it this way. If I ever came out and I was very bullish in a day, you better believe it's a super bullish day, because right now I'm pretty bearish. But when that day comes, the data reveals itself, I will be the most bullish person you possibly can get. But I have to tell you the reality, and that's just what I see. So look, that's it for today's news. If you got to take off, take off. You've been here for 24 minutes. I appreciate you stopping by. I really do. Now, if you want to stick around, we'll do a little Q&A. I'll answer all your burning questions to the best of my abilities, and we'll go from there. So take off. That's good. Thanks for stopping by. Now let's get into a little Q&A.